Hey everybody, I'm Aaron Norris. It's August 17th, and this is the Norris Group's Real Estate Headline Roundup in 2. First up with the national numbers, TransUnion saw all but 5 states have decreases in mortgage delinquency rates, which dropped from 5.78% to 5.49% in the second quarter of this year. Commercial mortgage-backed security delinquencies decreased to 8.48% in July as a result of an increase in loan modifications. Foreclosure radar says foreclosure sales were up 10.4%, and notices of default were flat in California for the month of July. 385,000 permanent loan mods were completed in the first half of 2012, according to Hope Now, which brings the private sector alliance to 5.6 million mods since 2007. Builder confidence increased for the 4th month in a row and is at its highest since February of 2007, but housing starts are actually slightly down. Mitt Romney's selection of Paul Ryan for VP gives some insight into how the team would approach Fannie and Freddie. Ryan released a plan last year that proposed the complete wind down and privatization of Fannie and Freddie, including almost $200 billion in bailouts. Obama has released 3 options for addressing Fannie and Freddie over the last year, but it's no surprise those got stuck in Congress. Expect to hear more as the Mortgage Bankers Association, the National Association of Realtors, and the National Community Reinvestment Coalition chime in and give their opinion in the coming months. The newly formed CFPB is issuing another guideline for a new proposed rule for higher risk loans. Dodd-Frank defines higher risk loans as a closed-end consumer credit transaction secured by a principal dwelling with an APR exceeding certain statutory thresholds. Think Reg Z guidelines. Under the new proposal, creditors could make a higher risk loan only if there's a professional written appraisal by a certified professional. Appraisers are going to love that. There's a physical property inspection inside and out, no BPOs allowed, and applicants will receive a free copy. An additional appraisal would be necessary at no cost to the borrower if it's the primary residence of the buyer and is being resold within a short period of time or is selling for a higher price than the seller paid. Investors, that means it's going to affect you. Find the full proposal on our blog and read it to your heart's content. Ellie Mae just released a study showing community banks are feeling increased regulations are hindering their mortgage businesses. Many smaller banks fear losing customers to bigger banks because they are more able to quickly adapt to regulations by institutions like the CFPB. Bill Loving, chairman-elect of the Independent Community Bankers of America, said, "Community banks are common sense institutions that maintain the highest capital levels in the banking industry. They should not be subject to the same complex standards required of larger and riskier financial firms." That's it for the news this week, but as always, there are many more headlines on our blog at thenorrisgroup.com/blog. Up on the radio show this week, we've got Mike Cantu, Tony Alvarez, and Rick Solis talking to us about the current market and investing in different parts of Southern California. October 19th, hopefully you have your calendars marked for I Survived Real Estate. You can find out more information about our award-winning fundraising event that's raised over $250,000 for charity since 2008 at www.isurvivedrealestate.com. For more information about hard money lending and all 5 of our programs, check out thenorrisgroup.com. If you're looking for a 9% return with trust deeds and looking for something a little bit more interesting for your self-directed IRA, check out tngtrustdeeds.com. Have a fantastic Friday and weekend, and we'll see you next week.